On February 3, 2022, Marcus Webb lost $10,104 in a single trading session. The entire loss resolved before the New York Stock Exchange closed at 4 p.m. Eastern. Marcus was 34 years old, a marketing manager for a logistics company in Naperville, Illinois, earning $72,000 a year. The $10,104 represented 37% of every dollar he had saved in the preceding 3 years. It was not borrowed money. It was not retirement savings. It was money he had accumulated, deposited into an active trading account, and placed into a position he had convinced himself he understood. This is the documented account of what that position was, why he took it, and what the mechanics of that loss reveal about decisions retail investors in his situation make at a frequency significantly underreported in financial media. To understand February 3rd, and it is necessary to understand where Marcus stood in the 18 months before it. In August 2020, he was earning $72,000 annually at a logistics firm in the western suburbs of Chicago. His monthly take-home after withholding was approximately $4,400. Fixed expenses: rent, a 2018 Honda Civic loan, utilities, and groceries came to $2,850. He was saving $1,200 to $1,500 per month. Over 3 years, he had built $27,800 in a high-yield savings account, earning 0.45% annually. He carried a $4,200 personal loan at 6.9%, but no credit card debt. His 401k held $11,300. By every standard measure, Marcus Webb was financially stable. What he also had was a growing frustration. The federal funds rate sat at 0 to 0.25%. His savings were returning below inflation. The S&P 500 was marking new all-time highs. In the Reddit communities and YouTube channels he followed, the argument circulated that holding cash in a near-zero-rate account was itself a form of financial risk, the quiet erosion of inflation-adjusted purchasing power. Marcus found it persuasive. Most people in his financial position at that moment in 2020 did. In January 2021, the GameStop short squeeze ran the stock from $19.94 to an intraday high of $483 in 17 trading days. Reddit's Wall Street Bets grew from 2 million to 8 million subscribers in 3 weeks. Marcus did not participate. He later described an inability to find a rational entry once the price had detached from any fundamental range. What he could not avoid was the accounting among people around him. Two colleagues at the logistics company reported gains of $4,100 and $7,800 respectively from trades placed that month, amounts that exceeded what Marcus accumulated in an entire quarter of disciplined saving. In February 2021, he opened a Robinhood account with $2,000 from his savings. He used $297 to purchase 47 shares of AMC Entertainment at $6.31. By April 26th, AMC had reached $9.68. His $297 position was worth $455, a 53% return in under 3 months on a single purchase decision. In May 2021, Marcus increased his Robinhood balance to $10,000. Between May and October 2021, his portfolio grew to a peak of $16,400, a 64% return on $10,000 in approximately 5 months, against an S&P 500 return of roughly 14% over the same period. The primary driver was not a stock, and it was 10 call option contracts on Palantir Technologies, ticker PLTR, purchased in late June 2021 at a premium of $1.45 per share, strike price $22, expiration September 17th. Total outlay $1,450. When PLTR moved to $26.50 by mid-July, the contracts were in the money. Marcus sold 6 of the 10 contracts for a combined gain of $3,180, then closed the remaining 4 in early August. Total return on the Palantir position: 346% on premium paid in approximately 7 weeks. Marcus had studied options mechanics before that trade. He understood that a long call's maximum loss is capped at the premium paid. What the Palantir outcome did was convert that conceptual knowledge into an empirical reference point. The mechanism had worked at a scale no equity position over the same period would have replicated. The 346% return arose from a specific confluence of timing and equity movement that could not be assumed to repeat. But what it registered, psychologically, was evidence. Before we continue, let us know in the comments where you are watching from. We would love to hear from you. And if this kind of financial storytelling is useful to you, hit that subscribe button so you never miss a story. In November 2021, Marcus received his annual bonus, $8,500 gross, $6,100 after withholding. He used $4,200 to retire his personal loan and deposited $3,000 into his brokerage account, bringing active trading capital to $13,000. On November 22nd, the Nasdaq Composite peaked at 16,057 points, then fell 15.7% over the following 10 weeks. Technology equities led the correction. The Federal Reserve was signaling accelerated rate increases. Rate-sensitive growth stocks were repricing sharply. Marcus had $13,000 in active positions as that correction developed. On January 18, 2022, Marcus purchased 30 call option contracts on Meta platforms, then trading at $331 per share, with a strike price of $340 and an expiration of February 18th. He paid $3.40 per share, $340 per contract, $10,200 in total. His thesis: Meta's fourth quarter 2021 earnings on February 2nd would confirm strong user growth and advertising revenue, driving the stock above $340 before mid-February. He allocated the full $10,200 to this single position. He held no hedge. He placed no stop-loss order. He had no defined exit plan if the position moved against him. On February 2nd, after market close, Meta reported that daily active users had declined by approximately 1 million quarter-over-quarter, the first such decline in the company's public history. Revenue guidance came in below analyst consensus. In after-hours trading, Meta fell 26.4%, erasing approximately $237 billion in market capitalization, the largest single-day market cap loss ever recorded for a publicly traded company at that date. The following morning, February 3rd, the Nasdaq fell 2.7% by mid-afternoon. Marcus's contracts required Meta to trade above $340. With Meta near $237, his $10,200 position showed a market value of approximately $120 by 11 a.m. He did not close immediately. He monitored through the morning and into the early afternoon, waiting for a recovery that did not come. At 2:47 p.m. Eastern, he sold all 30 contracts. Proceeds: $96. A net realized loss: $10,104. From the earnings call to the closing trade, less than 17 hours. Marcus was not in financial crisis. The loss came entirely from the active trading account, not his emergency fund, not a credit line, not borrowed capital. He held approximately $17,500 outside Robinhood, undeployed savings, prior withdrawals, and his 401k untouched throughout. His full accounting of the 18-month period: $13,000 deposited, $9,200 withdrawn in realized gains at various points, $430 remaining after the meta loss. A net gain of $3,370 before tax. Annualized, approximately 14.5% on capital committed. A $13,000 position in the Vanguard S&P 500 ETF held passively over the same period would have returned approximately 18.7% annualized, with no research, no monitoring, and no single position risk. And the strategy that felt like outperformance had, on a risk-adjusted basis, underperformed a passive index fund. Three mechanics arise directly from Marcus Webb's timeline. The first is expiry risk. Options are not equities. An investor holding a stock through a 26% single-session decline still holds the underlying asset. Recovery is available across days or weeks. An options buyer with a fixed expiry date does not have that option. If the underlying does not cross the strike before expiration, the contracts expire worthless. No recovery period. No waiting strategy. The $10,104 loss was not mechanically unpredictable. It was the direct outcome of placing 100% of active capital into a single binary event position with no exit discipline. The second mechanism is reference point distortion. The Palantir trade produced 346% in 7 weeks. This was a statistical outlier, a single data point that carried no predictive weight for what the instrument would reliably produce. But having experienced it, that outcome functioned as a persistent benchmark for every subsequent options position. A high-magnitude early win recalibrates the investor's intuitive probability estimates toward outcomes the instrument does not reliably deliver. That is precisely what happened between the Palantir exit and the meta entry 5 months later, when position sizing moved from $1,450 to $10,200. The third mechanism is the independence of conviction and risk profile. Marcus understood the 2 to 5% position sizing rule for options. He did not apply it because his meta thesis felt well supported by available data. And this is the structural error. Conviction level does not change expiry mechanics. A quarterly earnings announcement resolves on information no retail investor holds in advance. The same data available to Marcus was available to every institutional participant in that market, most of whom had larger analyst teams and faster execution infrastructure. The informational advantage he believed he held was fully priced into the options market before his order was filled. Marcus Webb rebuilt his trading account over the following 12 months. He did not exit the market. He restructured the terms on which he participated in it. He opened a Roth IRA for the first time, returned to equities and index ETFs with defined position limits per allocation, and did not return to single-stock options trading. Has there been a moment in your financial life where you held a position past the point where the thesis had clearly failed? Not because you could not sell, but because you were still waiting for a recovery? Tell us in the comments what that looked like and what finally moved you to close it. Next week, we are covering a case where someone exited a business partnership 6 months before it became profitable, having concluded from every available signal that the venture was in terminal decline. The financial consequences of that decision took more than 2 years to fully settle. That story will be published next Thursday. If this kind of financial storytelling is useful to you, subscribe so you never miss a story. New financial documentaries every week.